Hey everybody, it's Brian Shannon from alphatrends.net. Today's Friday, the 11th of January, 2019. Let's take a look at what these markets did this past week. It was positive. The markets gained ground once again as they continue to bounce up to some potential levels of resistance. In particular, the semis had a strong week and the biotechs. So let's take a look at the S&P 500 to start out. As we know, we are still below a declining 50, 100, 150, 200-day moving average, and we are now approaching this prior band of support. As I've pointed out on Twitter and in a couple of other places, what we want to look at here is, of course, we have that prior band of support in here, which is defined basically 261 to 263. And then we can also take a look at the Fibonacci off of the December high, and you can see that's pretty much exactly where we see a 61.8% retracement. Well, let's go back to the daily time frame for a moment, and you can see that's almost exactly where we see the 50-day moving average as well. So that is a potential level of resistance. It doesn't mean the market will go up there and decline, but support broken does tend to act as resistance. The psychology of that is people that owned over here and felt good about it, might be looking at it and saying, hey, now I'm looking to get out at break even. And there's a self-fulfilling prophecy as well, as people say, hey, look where it's come from, 235, up 11% right now in the last 10 and a half, 12 days, whatever it is, since the 26th. But the point is, it's getting extended to the upside, and it's coming into a potential level of resistance. So where has it come from? Well, again, up 11%. Where does it have the potential to go before it's likely to find some supply that might slow it down and provide resistance? That's basically right up here. So as far as new purchases in this area go, it is, the momentum is higher from an intermediate term perspective. Let's take a look at the volume weighted average price year to date is down at 253. And what I talk about all the time is the direction of the 5-day moving average. So the 5-day moving average is this orange line. If you take a look at guilty till proven innocent, while it's below the declining 5-day moving average, or as the 5-day moving average is declining, and innocent till proven guilty while we're making higher highs and higher lows above a rising 5-day moving average, it says that although we're potentially approaching some resistance, it's not time to sell short in here, and it's not time to panic and throw your stocks away. We now need to look at what are the areas that, if this market pulls back, where is there likely to be found some support? Well, we have the 5-day moving average. We have the volume weighted average price off the December high, which did act as resistance before. So maybe that's support, or the year to date. So I think that as long as we can stay above this 253-ish level, that we can look at the intermediate term trend as constructive, but within an overall broader downtrend. So we have earnings coming out begin next week, beginning with the banks. Let's just take a look at the bank stocks and see where have they come from? Well, they got banged up really bad here in December, and we've retraced a part of that now, so we can take a look at a retracement and say, a normal retracement might bring us up to 61.8%. Well, lo and behold, that's exactly where we see that declining 50-day moving average and the prior support in here as well. So that 25, let's call it 25.30, is a potential level of resistance. What that means is, let's say the banks gap up and they run up towards that level. It's likely that they either, consolidate there or begin to reverse and pull back a little bit. Perhaps they, so it'll depend on, do you want to gamble on earnings reports at this point? Because that's basically what you're doing if you're buying a bank stock in front of the earnings. Maybe you have super good fundamental analysis, and that's a different story, different from what I do here, is looking at the supply and demand of the individual stocks. But if you buy into that, it's harder to control your risk. That is, if the stocks instead gap lower and you bought in here betting there would be good earnings reports, well, then that's a difficult position to deal with. If you're betting on the upside, where do we have the potential to go before it's likely to encounter resistance? 25-30-ish. So there's not a whole lot of potential reward to take that bigger risk in front of an event, meaning the earnings. The good thing about the earnings is that these markets have kind of built in a cushion, meaning that if they decline on earnings reports, it might be, that the market can recover a bit from there. So people are still talking about, testing these lows. I think they're a little too far away for a retest right now until we see the market break down and hold below a declining 5-day moving average. That's not really on the table. So let's take a look at the NASDAQ. The NASDAQ obviously, has made some progress here as well. It did get back above this prior band of support. There was no resistance there. We spoke about the potential resistance level. Other people say, hey, it was at resistance. There was no resistance though. It sliced right through that 158 level. Let's take a look at the 15-minute time frame. Was there any real resistance at 158? No, there was not. We still have an advancing 5-day moving average. So from an intermediate term perspective, this bounce is still healthy. It's coming into a level where we have the potential at the 50-day moving average to find some sellers. So we want to be alert to that. This is also a 61.8% retracement of the December range and the declining 50-day moving average. So these are levels to be aware of. The Russell 2000, we're right up against that prior band of support. We're at the 50-day moving average. If we take a look at the Fibonacci off the December high to the December low, 61.8%. That is a perfect retracement. This is where we're supposed to find resistance. This is where a counter trend rally is supposed to fail. But there's no evidence of that, so there's no reason to be a short seller. Perfect example of why not to short at where there's supposed to be resistance would be the biotechs. There was supposed to be resistance over here. We've spoken about that. There was supposed to be resistance at the 50-day moving average, but the biotechs have had some favorable takeover in that takeover activity in that group recently, and they continue to rally here. So the people who called this resistance were obviously wrong. Resistance is only known after the fact. Once it rallies up to a level, begins to stall out and then decline, it's only once it begins to decline that it's resistance. Until then, it's a level of interest to look at the potential for resistance, but don't fight the trend. So at 101, where that prior support was there any evidence at all that the sellers gained control in these biotechs? And the answer is none whatsoever. We still have a rising 5-day moving average, and we still see these higher highs and higher lows above that rising 5-day moving average. So what people were talking about on the daily chart meant absolutely nothing, just as it really doesn't mean anything here on the S&P 500 other than a potential level of resistance. Maybe the S&P does this, goes sideways for a day or two, brings in short sellers, and then ramps up to the 200-day moving average. I don't have a crystal ball, and if I did, I would say it's probably broken. I'm not here to predict the future, but to look at it from a risk-reward perspective and say, I'm not going to play guessing games and put my money at risk and fight the intermediate-term trend just because the longer-term trend is down. What we need is an alignment of trends. Semiconductors are another good example of, first of all, the weekly time frame still clearly in a bearish environment, lower highs and lower lows. Going over to the daily time frame, it was supposed to find resistance in this area. There was none. It's at the declining 50-day moving average. How about the Fibonacci off of the December high to the December low? Almost precisely, again, at the 61.8% retracement. So now that we're at this 50-day moving average, does it, and the 61.8% retracement, does it make sense to sell short? No, it doesn't. There is zero evidence the sellers are gaining control. Even from this gap higher 3 days ago, that volume weighted average price, you can see, was defended on the open here today. So wait for distribution. If you're long these stocks, maybe you lighten up into these potential levels of resistance, but then raise your stops to the levels that are appropriate for your time frame. That's all I have for today. Thanks for tuning in and have a good weekend.